Focus on the relationship, not the transaction. This is my advice for founders that are going through a capital raising process. And here's why. So now I've given you the advice for this video straight up front, which is focus on the relationship and not the transaction. What I've really noticed recently is that there's a lot more founders who are sort of in their earlier stages of their capital raising process, or that's their first or second time going through a capital raising. And what they're doing is they're so relentlessly focused on the transaction part that they forget about the component of what it comes to a relationship. And I want to do this video to highlight this because I think for any founder going through a capital raise, there's some few important things that you really need to understand. The first one is a lesson that I got taught by one of my mentors, and that is this. This is the number one principle that is going through an investor's mind that people forget about. The first one is that it is harder to get out of an early stage company than it is to leave a marriage. Just think about that. It's actually easier to go through a divorce than it is to get out of an early stage company. And that's just the truth. That's the fundamental truth that sits at the bottom of what it means to be what it means for an investor going to an early stage company. Now look, we're all passionate about the space. We all love innovation. We all love dealing with founders. The reality is what most founders do is they'll speak to an investor. They may get a no, or they may get some negative feedback, or they may not hear from them, etc. And then they just ditch them. They typically don't do any follow-on communications. They don't provide any updates as far as how the company's going, but they expect things to happen like that. And unfortunately, that's not how this space works, right? Unless you are doing 100+% year-on-year growth, or you're doing 10% plus, 20% plus month-on-month growth, that's just not going to be the experience that you're going to have, and especially if you're pre-revenue. Right? So it takes a lot more work. It's a lot more relationship building than what you can imagine. And I was very fortunate that I learned this lesson early on about the relationship aspect. And that's because I spent a lot of time in Singapore, where a lot of business is purely done by the time it takes to spend to build a relationship with someone and getting to know, like, trust, and respect someone. And so if you understand that principle, that it's harder to get out of it's easier to get out of a marriage than it is to get out of an earlier stage company, that will give you some context. And you've got to understand, if someone's looking to invest their money into your business, you should absolutely be treating that money with disrespect. So focus on the relationship, not the transaction. Treat this process with respect, treat the investors with respect, take the time, give them updates, provide them with milestones, execute on those milestones. One of the greatest ways to attract capital to your business is to say what you're going to do and then actually do it. And it's really funny that a lot of people see success in actually raising money, right? I don't see that as success at all, because the capital is just a byproduct of what you've executed on and you doing what you said you've executed on, right? You're going to execute on. And that capital is designed to allow you to invest into your business to further fuel that growth to the next milestones or to profitability, whatever is there for you. And so, as I said, treat this as a relationship. Focus on building the relationship, because you can learn a lot more from the actual process, and allow investors time to get to know your business. Give them that space to understand what you actually do. Let them get familiar. Let them see some of your milestones. Let them see some of your announcements. Now, I know what you're sitting there thinking, but Steve, I'm raising money right now. I need the money right now. I can see my bank account going down, and I've got staff, I've got this pressure, I want to do this, I want to do that. So sure. Start building those relationships 6, 12, 18 months before you're actually looking to raise capital. See, the biggest mistake people make is they decide to raise capital and then they go and start speaking to investors. Whereas they should have been having those conversations 6 months beforehand. They should have been building their profile. They should have been raising awareness. They should have been, out highlighting what milestones they're looking to achieve well before that, right? Because the more times that you actually allow investors to engage with your business, to engage with your milestones, to get visibility over how the business is performing, right? And how you're performing on what you say you're going to execute and then actually doing it, the easier it will become for you to go through the capital raising process. So, and then what you'll realize is that those investors can add far more value than what you'd ever imagine coming into your business. and they can assist in different ways because they actually have got more of an understanding. So once again, I'll just reiterate that feedback. Focus on the relationship, not the transaction when you're going through those early stages of the capital raising process.